We know that inflation is still very high and our current overnight rates at 1% is still too stimulating for our economy. Right now, our CPI continues to climb to 6.8% in April, and this is the highest we've seen since 1981. Now, this is a long way away from where Bank of Canada would like us to be. Here's the thing, since 1991, the Bank of Canada made an agreement with our federal government to keep inflation at 2%. The central bank believes that keeping interest rates between 2 to 3%, which they call the neutral rate, will be what it takes to keep inflation at 2% in the long run. And now, here is the plot twist. Last week, Bank of Canada came out to say that they might not just look at inflation moving forward. Because Canadians have so much debt tied up in real estate, what happens to real estate could affect where Bank of Canada sets interest rates moving forward. And this is a big change. So in this video, let's talk more about interest rates, where they are right now, how high they might go, what it means for variable and fixed interest rates, and what we think about Bank of Canada using real estate to steer interest rate decisions. Before I continue, if you like content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss any more videos like this made specifically for real estate investors in Toronto. We've seen a couple of rate hikes this year already. Overnight rates went from the rock bottom 0.25% that we've experienced in the past 2 years to 0.5% in March, and then it went up another 0.5% in April. Right now, overnight interest rates are sitting at 1%. So if the upper bound of neutral rates are at 3%, we actually still have a lot of room to move up still. At the moment, the market is pretty sure that interest rates will go up by another 50 basis points on June 1st and maybe another 25 to 50 basis points in the middle of July. If this is true, we can expect overnight rates to go up to between 1.75 to 2% by the middle of summer. So your next question might be, how high will interest rates actually go? Inflation is really high right now, so naturally, people will start comparing us to what's happened in the 70s, which makes people even more nervous. If that's the case, will overnight rates shoot up to close to double digits again? If you're also worried about this, you can probably breathe a little easier now that the Bank of Canada has said no in a very clear way. Yes, it is possible that overnight rates will go above 3% for a short while so that inflation can be brought back down to target levels, but we won't be at the same levels as what we've seen in the 70s. Tiff Macklem said at the end of April that they're looking at a bit more than 2 to 3%, but not 7 to 8%. The Bank of Canada then compares how different we are right now compared to the 70s, but that's a different topic, so I'll make another video about that later. Now comes the interesting part about interest rates and real estate, which they started bringing up last week. Even though the central bank is only supposed to monitor inflation, they might end up looking at real estate as well to help them steer how interest rates move in the future. They say that higher interest rates can cut down on the excess demand on real estate, which can reduce inflation. And if that works, we can expect a soft landing in the real estate market, and then growth should start to slow down and normalize after that. But Canadians may have taken on too much debt, so they also worry that if interest rates go up too quickly, it can cause a crash in the housing market, which does more harm than good. And so if that happens, they'll have to pause raising interest rates. To round out the argument, they also talk about the other side. If real estate prices stay high because demand is so strong, the central bank might have to raise interest rates above neutral rates to actually lower the demand. So, as of right now, it sounds like the central bank wants to raise rates as soon as possible to get to our neutral range. Rates should stay between 2% to 3% in the long run, but in the short term, we might hit some speed bumps or go beyond 3% for a little while. So let's take a look at what the big banks think interest rates will be for the rest of this year and next year. Keep in mind that right now the market is expecting a 1.75 to 2% for overnight rates by the middle of summer. Now, if you look at this chart, you can see that the banks actually have a wide range of expectations. TD forecasts overnight rates to be 1.75% by the end of 2022, meaning it won't even hit the lower bound of neutral rates. This also means that rates probably won't change much after the summer. Most other banks expect a small rate increase from summer to end of the year, but Scotia is the more aggressive one, thinking that rates will go up more, with overnight rates ending at 2.5% by year end. For 2023, all the big banks agree that rates will slow down, going up only 25 to 50 basis points over the whole entire year. Scotia's interest rate predictions still remain the highest at 3%, which is still within the neutral rate range. We can also look at yields on treasuries and bonds to find out what the market thinks as a whole. If you look at the yield on a 1-year treasury and a 5-year bond, you'll notice that the rates aren't so different. In other words, most of the interest rate increases should happen in the next year based on market expectations. Specifically, the market is implying that overnight rates will go up to around 2.5% by the end of this year, 2022, which is in the higher end of what the banks are predicting, and 3.5% in a year's time from now, which is higher than what the banks are predicting and above the neutral rate range from the Bank of Canada. Now, if you're trying to decide between variable and fixed rates for your mortgage right now, I'd say it's still more of a coin toss because where rates go depend not only on inflation, but also on real estate. But as you can see, the bond market is pricing in pretty aggressive rate hikes right now, and that sets the basis for fixed rates. This means that if overnight rates go up by less than what the bond market has aggressively priced in, then variable rates will be the cheaper option. You should also keep in mind that as a real estate investor, you might also want more options when it comes to refinancing. So if that's the case, you would be better off with variable rates, which does have lower penalties if you need to get out of your mortgage early. I'll end with a few final thoughts about the Bank of Canada's new update on how changes in real estate could affect interest rate changes. We've already said that the Bank of Canada's main job is to control inflation, so we don't think it actually makes sense to use real estate to decide on interest rates. If they stop rate hikes because of real estate, there could be other things that could be detrimental. For example, if we pause on our side, but the Fed continues to increase rates on the US side, more money will flow to the US, and this will take down our Canadian dollar, which will actually cause inflation to go up even more in Canada. So, in our opinion, this might actually be a verbal tactic in order to give the real estate market more confidence and help it land more gently. No matter what, it is clear that the government and the regulators are now thinking about real estate in their decision making. And to us, this is positive because the government won't just let the real estate markets crash, which does make real estate a lower risk investment at the end of the day. But a soft landing does mean that prices will probably come down. Right now, buyers are having more bargain power to negotiate than they've had in years. As prices go down, it's possible for the market to overcorrect in the short term. So we think that now is the best time to buy real estate in Toronto. If you're looking to invest in real estate in Toronto soon and you want to chat more about this, we're ready for you. We can talk about your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.